When you're looking for funding to help grow your business, it's often unclear which funding channels you should choose and what process funders go through when deciding whether to invest in your business. This video will shed some light on all of these things and tell you what your likelihood of success is when applying for funding. Hello and welcome. My name's Terry Clark and this is Investor Connected, providing you with the best tips and tools to help you grow your business. On this channel, we provide insights into the world of growth finance, providing you with strategies on how to increase your effectiveness at fundraising, along with direct access to investors and what they look for when investing in a business. So, if you're new here and you find value, don't forget to like and subscribe. Competition for funding is tough and often very confusing. More and more entrepreneurs are looking for funding to grow their business, and whilst there are now more ways than ever of raising funding, many entrepreneurs are still unsure about how it all works and which funding channels they should choose. When looking for funding, it's often not transparent what processes investors and lenders go through when deciding to fund your business. This video will give you some insights into the general processes that funders go through and look at 4 different funding channels and some of the things you need to bear in mind if you're looking to apply to them. Finally, we will reveal what our research has told us is your likelihood of successfully raising funding from each application. So stay tuned for that. So, when applying for funding, it is extremely useful to know what the process is that you have to go through so that you can ensure that you are prepared for each stage. Understanding these stages and what you should expect helps you to be prepared and puts you one step ahead of the game. Although each funder will have their own unique process, in general they follow the same steps. I will give you an overview of these steps and what to expect at each stage. The first step in most processes is the initial review, qualifying your business's pitch based on basic criteria. Those basic criteria are there to help the funder to ascertain the viability of your business. In general, the most important things that will be assessed at this stage will be the problem that your business is solving, how you're going about solving that problem, what the market opportunity is, and what your business model is. Remember that someone reviewing your pitch will probably take 10 minutes or less to decide whether to proceed with your business. Step 2 will be the detailed due diligence stage. Here, they will look to get a deep understanding of your business, analysing its development and the traction you've managed to gain with your customer base and the revenue you have generated, if any. They will also want to dive into the details of your business's growth strategy and want to know about key members of your team and their capability of delivering the strategy. Step 3 is often the legal due diligence stage. Here, funders will want to look at the governance structure of your business, including your articles of association, shareholders agreements, and other contracts or documents that have a significant bearing on the governance or effectiveness or profitability of your business. Step 4 is negotiation. Usually, an offer for funding will be made using either a term sheet or heads of terms. For equity investments, this will contain details of the price that the investor is willing to pay and what share of your business they would like in return. These offers often also contain additional provisions on the governance of the business, which protects the investor's investment. Loans tend to be a little more straightforward and contain details of the interest rate to be paid, duration of the loan, and details of any collateral that may be used to secure the loan. Finally, the stage every entrepreneur longs for is completion. Here, the funding is provided to your business immediately at the end of the funding round, or perhaps even in installments. Congratulations, you've successfully raised your funding. However, through all of that process, most entrepreneurs fall at the first step. So it's important to be as prepared as possible when fundraising. So now you know the rough process, we're going to break down some of the different funding channels that you may be thinking of applying to and give you some insights into how they work and what you need to consider when applying to them. We're going to talk about 4 different channels of funding and what you should bear in mind when deciding which one to pursue. Firstly, I want to talk about loans. Loans are by far the most popular way of raising growth capital, whether it be through high street banks, specialist business lenders, government schemes, or peer-to-peer platforms. Loans are a great way to fund your business. However, if you wish to apply for a business loan, you need to be in a position to pay back the loan, often from the first month you take it out. That means that your business really needs to be generating sufficient revenue to cover the loan repayments. For businesses that are cash generative, that's great. But for those that are not yet generating revenue or would struggle to pay the monthly loan repayments, they may not find this type of funding easy to use. However, if your business is in a position to apply for a loan, you have about a 22% chance from each application of raising the funding that you need. That's the highest of any other type of funding channel. So, if you have a business that is already generating cash and you think that you can service a loan, this may be your best chance of getting the funding that you need to grow your business. Next, we're going to talk about different channels for raising funding using equity. The natural first place to start is looking at angel investors. Angels are merely a description given to individuals that invest in early stage businesses. Increasingly, angel investors are professionalizing and are coming together in groups or joining networks in order to invest in startups or scale-ups. Being in groups enables angel investors to access and fund more businesses, which diversifies their portfolio and reduces the risk of them losing their investment. Many of these groups or networks have mimicked professional investment managers and now have formalized investment processes which they follow when selecting businesses. One of the trends that has developed over the last few years is that there has been a rise in the number of groups or networks that will require you to have an identified lead angel investor in your business, which you need to come to the table with before they will even consider your business for investment. In the UK, platforms such as Angel's Den and Syndicate Rooms have this as a key requirement and often rely heavily on experienced angel investors to lead funding rounds. Nowadays, angel investors can access a lot of businesses, which means competition is high, and therefore your chances of successfully raising funding from each application are around about 1.6%. So, if you're looking to raise investment from angel groups or networks, the key is to find a lead investor that will spearhead the funding round and will champion your business. Use them to help convince other investors of your business's growth potential. The next equity funding channel that we're going to look at is crowdfunding. Crowdfunding has seen a huge rise in popularity over the last 4 years and continues to grow rapidly, both in terms of deal volume and size. When using crowdfunding platforms, in order to access the crowd and be publicly visible to investors, businesses often need to have privately raised up to 40% of their funding target. As this is a form of momentum investing, the crowd often don't start investing until the business is close to or over its funding target. Contrary to popular belief, raising funding using crowdfunding platform is still difficult, requiring a lot of marketing, PR, and investor relations. Businesses still need to do a lot of work themselves. However, of all of the equity channels, this provides entrepreneurs with the greatest chance of success, and you have around 5.3% chance of raising funding from each application. So, if you're looking to use crowdfunding, think carefully about your fundraising strategy, the amount that you want to raise, how much you can raise from your own network of friends and family and customers to get you over the hurdle and ensure that your campaign is publicly visible on these platforms. Additionally, make sure that you budget enough for PR and marketing in order to ensure that you get everyone excited about investing in your business. Last but certainly not least, we're going to look at venture capital firms or VCs. The number of VC firms has increased significantly over the last few years, as many successful entrepreneurs look to deploy capital from exits of their own businesses into the startup or scale-up ecosystem. Due to their visibility and the volume of applications they receive, many VCs now make it more challenging to apply to them. As a consequence, most VCs tend to prefer warm introductions from associates or their existing portfolio companies. Many VC firms now offer office hours in order to meet new businesses and more effectively manage their deal flow. However, access to these is very limited and businesses only have a short amount of time to pitch their business. As professional investors, VCs are the toughest to succeed with only a 1.1% chance of getting funding from each application. So, if you're looking to access VCs, try to scour your network on LinkedIn, Facebook or anywhere and see if you know anyone with connections to the VC that you want to talk to. Then you need to beg and plead them to make an introduction. Failing that, check events and office hours to see if you can get some FaceTime with someone from the team. Hopefully this video has given you a little more clarity on how the funding process works and provided you with some useful tips on what to look out for when considering each channel. If you want more information on some of the facts and figures from the UK, check out our Funding Landscape 2020 report, a link of which is in the description below. Thank you for watching. If you found this video useful, don't forget to hit that like button and subscribe for more great content on funding and business growth related topics. As always, take care and have a fantastic day.